to know to be able to successfully open a trading account with an FCA regulated broker. That's what we're going to cover in this video. All right, so my name is Alejandro Zambrano and I'm the Chief Market Strategist with ATFX UK, and I work for 3 different FCA regulated brokers, and before that I used to work for a bank, which was also regulated, but not necessarily by the FCA. So I have a good understanding of what the FCA and brokers want from new traders with no experience. Because you see, when you apply to a trading account nowadays, they're going to ask you, have you traded in the past? And if you have traded in the past, then it's quite straightforward to open an account and it doesn't take more than a few minutes. However, if it's a situation where you have no trading experience, you never worked with anything related to finance, then they will ask you a few questions, which in fact are quite easy to answer if you know if you know a bit about trading. And that's what we want to make sure. After you watch this presentation, you'll have that basic knowledge to pass most, if not all, of the different questions that different brokers are going to ask you. Now, why is it like that? Well, because unfortunately, a lot of retail traders lose money, and the regulators in Europe and also in the UK, the FCA, have increased the requirements on traders before they can open accounts. And this is not that strange. Like, if you look at it, you know, I don't know how many years ago, so I didn't research this, but I can imagine that maybe 100 years ago, so you could just get a driver's license, or you didn't even have driver's license at that point. You can just buy a car and then you can drive. And then probably, I don't know, 60 years ago or something like that, you could do a test, and that test would last like 1 day or something like that, or 2 days. Like nowadays, before you can get a driver's license to drive a car in the UK, you do need to spend, I don't know, 30 hours, maybe 40 hours behind the wheels. Plus you need to do the theory test before you actually get your driver's license. Why did they do that? Of course, they do that so less people are going to get hurt in traffic. And it's the same here. They want to make sure that you don't make any silly mistakes that's going to blow up your account as well. You need to understand what the risks are with trading, because unfortunately the way it's portrayed in the on Instagram, on Facebook, on Twitter, and even by Bloomberg and all the press really, is that it's glorified. You know, many times we talk about the big moves in the market, how this hedge fund manager made X amount of millions or billions for that matter. And of course, the bad stories don't really get too much attention. And that makes people think that it's super easy to make money trading. And if you know what you're doing, yes, it's relatively easy, but a majority of people lose money, especially if they're new. And what the FCA wants to do is want to make sure that, again, people don't do silly mistakes. They know what they're getting into before actually committing real money to it. So that is really why things have become much more difficult, because people have been losing money and they want to avoid that. So what is it that you need to know, and what is it we're going to cover over the next couple of minutes? I'm going to explain to you the difference between buying and short selling, how stop losses and take profit orders work, lot sizes, and we're also going to talk about leverage and margin requirements. So let's dig in. What's the difference between buying and short selling? So buying is, as it sounds, you buy when you think something is going to increase in value. So say, for example, we buy something at 100 and then we get out at 110. That's you bought, right? You bought and the price went up. So for example, if I buy gold at $1,200 an ounce, and then I close the position at 1,300, then would have made $100 in profit per contract, or lots really. So the amount of gold obviously influences. If you just buy 1 ounce, you'll make $100. But if you buy more than 1 ounce, you make more money. If you buy less than an ounce, you make less money. And this is what we call a buy position. And in traders lingo, we call that going long. So if you hear traders like myself or other people talking about going long or being long, it's just meant that we bought something because we think that the price is going to gain. However, of course, if you buy at 1,200 and the price goes down to maybe something like 11,000 1,150, then you would have lost $50. What is now short selling? Short selling is also called going short, which means that you predict that the price of an asset will decline. Without explaining exactly how that works, because that's something you can expand on quite easily, just look at it like this. You can make money on something going down in value. Simple as that. You can press on a button, and pressing that button means that if the price of that asset goes down, you will make money. On the other hand, if it goes up, you will lose money. Let's take a look at some examples here. So in 2020, you might remember that crude oil prices were trading around $55, $65 per barrel. And as the COVID-19 crisis expanded, and it was very apparent that the demand for crude oil wouldn't be high anymore, and as well as a trade war started between all countries really, but led by Saudi Arabia and Russia, crude oil prices for a short while actually went to zero. So nobody wanted to have crude at that point because there was no place to storing it. So effectively, you could have sold when the price of $1 a barrel was at 65, and then when it went down, even if it went down with like 10 cents or 20 cents, you would have made money. But in fact, it went all the way down to zero. And how does that work in a platform? Well, in an MT4 platform or any other trading account, you usually find two buttons. You got to find the sell button and the buy button. Now, if you are neutral, in other words, you're not holding any position, if you click on sell, then you're taking a short position. So if you look at this price here, the price was at 45.85. Now, if I click on sell here, and the price goes down to 40.85, then one would have made $5 per contract. Now, if I would just trade one barrel, I would effectively just made $5. But if you look at this little section here, this is not the amount of barrels, but it's just the size. And you can actually manipulate this to get more than $5 per contract, or more than just buying more than one barrel, right? And so long story short, you can make money on something declining. So if someone says, I'm short selling, that means that they're betting on the price to slide. Now, the challenge with this is that if the price doesn't go down as you projected, instead it goes up. So it goes from 45.85 to 47.85, then you would actually lose money. So it's not a free lunch here. You could actually lose money if the price goes up instead of coming down. Now, what's a stop loss order? A stop loss order is very straightforward. It's just an order within your broker or the platform that will get you out in case of a loss. Say, for example, I buy something at $150 a barrel, and then I put, or $150. Say I buy a share of something. So that costs, I bought one share, I'm buying at $150, and then I put a stop loss at $140. If the price goes down now, the system would automatically sell my share, and I would have realized the loss of $10 per contract. This is great because, for example, like right now as I'm doing this webinar, I am holding a position. I'm holding two positions actually. I'm trading a currency pair. I'm also trading the Euro Stoxx 50, which is the stock index of the 50 biggest company in Europe. Now, I'm talking with you guys, so I can't see what's happening with that position. I can put alerts on with my broker so I can get a notification and all of that. But what's better? A stop loss order. So I have a stop loss order for that position with my broker. So even if my platform is closed right now, if the price slides, it will get me out. And you need to have this because right now maybe I'm up a bit, but what if the trade war between US and China picks up again, or President Trump says something and we have a big slide, or I have news that COVID-19 is jumped by a great amount, or someone thinks that COVID-19 is going to jump by a great amount, then all of this creates volatility in the market. And maybe it's correct, maybe COVID-19 will come back strongly, then maybe I don't want to be holding on to stocks at that point, because we saw what happened earlier in the year when stocks declined by a ridiculous amount, really. That's why we use a stop loss order. And long story short, it's a function within your platform that allows you to get out at a predetermined level at a loss. Let's take a look at some slides. This is me looking at the Euro USD. You can see that this is a symbol for Euro USD. You can see the volume. You can see that these are the buy price. I can sell here if I want to. If I click on sell, I'll make money on the euro declining. I can also click on buy. That means that I'm going to make money when the euro goes up. So the price for the euro when I took the snapshot was 119.52. If I click on buy here, I could within my system here put 119. I could in fact put whatever I wanted. But the key point is, because I'm buying, the stop loss needs to go below the buy spot, the buy price. And the idea here is very simple. If I buy here and the price goes down to 119, I would have lost 52 pips, or 0.0052, and that's what we call pips. So the fourth decimal in a currency pair like the USD is called the pip, and this is a stop loss. You can also see this, which is a take profit order. So take profit order is just an order to get you out in case of profit. Isn't that amazing? You can trade today, you decide where you want to buy, you put the stop loss, and then you put your take profit. And that's exactly what I did as well. So if I walk away now and do something else, if I have a dog and I want to walk my dog, or I need to pick up my son from nursery, for example, or school or whatever, the system will take care of all of this. And the take profit order is just a level to get you out in case of a profit. And a lot of people, especially on social media and so on, instead of writing it out TP or take profit, they would write TP for take profit, SL for stop loss. So if I buy 150, I can put, for example, a stop loss take profit order at 165. That means that if the price would gain with $15, then the system would get me out automatically. Here with the MT4, we're having the Euro USD again. So you can see that I have my stop loss at 119, and I put take profit order at 120. If I click buy here, we go up to 120, the system gets me out automatically. These are two key things that you can use to manage your risk better, making sure you don't blow up your account, and also making sure you take profits. And a lot of traders say you shouldn't be buying or selling until you know where to put your stop loss and where to put your take profit level. We're not going to cover this in this presentation, but we do have courses with ATFX that you do get for free. We got the premium trading course that shares more light to how I manage my stop loss orders and how I manage my take profit levels. Leverage and margin. All right, this is a key concept. And I think the best way of explaining this is to use an analogy from a totally different sort of investment or purchase. Imagine that you buy a flat. You buy a one-bedroom studio in London for £400,000. Now, you will usually not be required by the bank to, give $400,000 to get your flat. They would be perfectly happy for you to lend you a majority of the money. So for example, here I'm assuming that you have what we call a 40,000 deposit. So I can, with the help of 40,000, I can buy something for 400,000. Well, at least you could do. Now the requirements are a bit different. I think you need to have 15% of the money. But I'm keeping it simple here, so when I show you the mathematics, it makes easier sense. Now, I can buy for 400,000 with just 40,000 deposit. Now, if I divide 400,000 by 40,000, that's 10. So I'm using 10 times leverage. Now, what's the margin then? The deposit is the margin here. And that means that when someone speaks to you, okay, what's the margin requirement, or what's the margin you put up for that position in the Euro USD or gold or something, effectively what they're asking, what's the deposit requirement, or how much deposit did you put? And this is a key concept here. Let's use another example then to explain this further. I want to buy a place for 250,000 with a margin of 30,000. What's my effective leverage? Well, let's find out. We're gonna bring out a calculator and we're just gonna take 250,000 and then we divide this by 30,000, which is our deposit or our margin for buying this flat. 250,000 divided by 30, that's 8.33. So I'm buying here with 8.33 times leverage. When you trade currencies, you can trade up with 30 times leverage. Back in the old days, you can trade with 100 times, sometimes 500 times. I know it's crazy. Why? I'll explain to you in a few minutes. In fact, I'll explain to you right now. So if you buy a flat for 400,000 and after 3 years, that flat is up with 10%. What's 10% of 400,000? Well, that is 40,000. How much did we deposit to buy this flat? Well, 40,000. So we made 40,000 on our 40,000 investment because this is our cash. The rest of the money comes from the bank. So we made 100% return on this position or this purchase of a flat. And with the change of the underlying market or the underlying asset, which is the flat, we can take that. So this is 10%. And then we can multiply that with the leverage. And that gives us what we call the effective return. In this case, it's 100%. So back in the old days, you could trade with, as I said, up to 500,000 leverage, but most brokers would sort of limit it to about 200. What did that mean? Well, take something like the Euro USD. The euro versus the dollar would on average move with, say, 0.85%. Let's make it super easy. The euro moves with 1% per day. Now, if something moves to 1% per day and you have bought with 10 times leverage, well, 1% multiplied by 10, that means that you're getting a 10% return on your investment. Well, what if you bought with 100 times leverage? Well, then you would have made 100% on your deposit. That is why back in the old days, you would see people effectively, doing 200-300% in just a week or two. What's the drawdown with this then? Well, what if the market moves against you with 1% and you're trading with 100 times leverage? Well, you would have wiped out your whole account in one day. So you see, clients were making a lot of money quickly, but they were also losing a lot of money quickly. And a majority of cases, people would just lose money. And that's why leverage on currencies has now been limited to 30 times leverage. On indices is about 20 times leverage. And on some high risk things is 10 times leverage. And on some super high risk stuff like cryptos, you're usually limited to 2 times leverage. What is it you need to remember from here though? Is that this is the deposit here is called margin, and that this could amplify your losses and your profits. Now let's make this more relevant for what we're doing here. So currencies are trading in lot sizes. If you want to trade indices, they're also in lot sizes or specific amounts. And why is it like this? Well, because to make it simpler for everyone involved, you can't just go, or you can now to some extent, but before you couldn't. And again, to some extent, you still can't just buy random numbers of currencies. Rather, you would need to say, I want to buy 1,000 units, 10,000 units, or 100,000 units. The mini lot is 10,000 units, and that's the typical size that most people trade. If the Euro USD moves with 1 pip, you would make $1 or lose $1. And because the market maybe moves with 80 to 100 pip a day, by buying one mini lot, you would stand to gain or lose about $100 per day. And that's sort of where most retail traders are at. But these are the 3 different lot sizes: the micro lot, mini lot, and standard lot. A lot of brokers are going to anticipate that you know about this, so it's important you write this down. Now, this is just an example how it works. If I want to buy the euro against the dollar and I buy one mini lot, then I am effectively buying for 10,000 euros. And what is that in dollars then? Well, you take 10,000 multiplied with the exchange rate, and that would be 12,600 US dollars. What if I want to trade something like the dollar versus the Japanese yen? Well, the pricing of the dollar versus the Japanese yen is very different to the one for the Euro USD. So here, for example, 1,000 multiplied by 104, and here $1,000 effectively gives me 104,000 Japanese yen. And you might say, oh wow, that's a lot of yen. It's true, it's a lot of yen, but is it really worth a lot of money? Not necessarily, because if you just want to buy a Big Mac, then you almost need to come up with 400 yen almost just to buy one Big Mac. But simply put, this is lot sizes. And how does that link up with lot sizes in ATFX and the empty full? Well, it's actually quite straightforward. If you have a spread betting, a CFD account, then one micro lot is the equivalent of 0.01. If you have a mini lot, which is 10,000 units, then that's the equivalent of 0.10. If you have a standard lot, which is the equivalent of 100,000 units, then that's the equivalent of 1. This is important to remember. However, if you want to use a spread betting account, then the situation actually is a bit different. You don't actually put the lot sizes you want to trade. Instead, you just assign how much every pip is going to be worth. And then the system will, on its own, calculate what the actual size is. So here, for example, this is EURUSD.SB, which is spread betting, and is 1. This means that what's going to happen here is that if we buy here, every change in the pip is going to equal £1 in my account. All right, let's dig a bit deeper into Forex leverage. So for most currency pairs, like most major pairs, like the Euro USD and the GBP USD and dollar yen, the maximum leverage is 30 times. That means that you need 3.33% as a deposit or as a margin requirement for the amount that you would like to buy. So for example, if you want to buy a mini position or mini lot in GBP USD, now that's 10,000 GBP, you will need 333 British pound, because 10,000 multiplied by 0.033 is this. But you could also, you can just grab something like a calculator and just divide it, so you don't have to multiply it. So you can take 10,000, divide that by 30, and you can see that this is the margin requirement. And this is actually quite interesting, because a lot of brokers they wouldn't tell you that there's a minimum deposit size, but if you realistically want to make some money, because of the margin requirements, you would need as a minimum put maybe £500 into an account, because otherwise you can't even open a position, because this is the minimum. But if you would open a position with just 333 GBP, a mini lot, you would be able to open the position and pay the spread maybe, but then automatically you will be closed out, because you need to give the position wiggle room. And you can't do that if you just have the minimum amount of deposit into your account. Now, most indices, the maximum leverage is 20 times. And the reason for this is that, something like the NASDAQ 100 could easily move 1-2% on a single day. The same thing with the FTSE 100 can easily slide with 2.75%, 3%. So when something moves a lot, the effective leverage is usually lower, and available leverage is usually lower. And here the margin requirement is 5%. So if we know that indices have a maximum 20 times leverage, say out of curiosity, just showing here, say I want to buy a position worth 10,000, then you just divide it by 20, and you can see here that you would need a 500 to open up that position. Let's dig a bit deeper here, because this is important and a lot of brokers will quiz you on this. So what would be the required minimum requirement for one lot, one standard lot. That's what it should say here. Well, if it is in Euro USD, and they also tell us that the maximum leverage is 20 times, then we just need to take 100,000 divided by 20, and that is how we end up with 500. So it's 500 that we need to open up a standard lot. Now, what if we want to open something more reasonable that a lot of people tend to do, like a mini lot? Well, if I want to trade a mini lot in GBP USD, then a mini lot, as you might remember, is 10,000 units. And then you just take 10,000 units divided by the margin requirement. Now, if it is the standard one, which it is, then that's 30. 1 to 3, that means that the leverage is 1 to 3, so 30 times leverage. So 10,000 divided by 30 means that to open this position, I would need to have 333.33 GBP on my account. And that concludes this overview of some of the key concepts that most brokers would ask you about. So you would need to know this to be able to open up, because when you apply to an account, they're going to ask you if you traded in the past. And if you say no, these questions are going to show up. And sometimes even if you put yes, the questions will show up, just because they need to make sure that you know what you're doing and that you don't make any silly mistakes. And the best way to ensure that you do pass and you don't make silly mistakes is to watch this video, which you just have done. And also, what is really good is to just practice a bit on a demo account. Open and close positions, get to know the platform to avoid costly mistakes. A lot of people as well, what they do wrongly is that they buy with huge volumes in the very beginning, and without really thinking into account what it's actually going to how it's going to impact your account. So what I usually recommend is start with very small sizes, get to know the market, understand how your strategy works, and then when you have that covered, you can increase the risk. Now, if you are interested to learn more about what you can get with an ATFX account, and a real account that is, you do get quite a lot actually. You get our ATFX Premium Trading course, which is a course I developed for ATFX. And I take my experience of trading since 2006 and present you with 2 complete strategies and also what we call money management. So if you do want to know where is a good place to put a stop loss, where's a good place to enter the market, and where's a good place to take a take profit order, then we explain that in the course. We also explain what the optimal buy amounts are to make sure we keep risks at a minimum, but at the same time maximizing our potential profit. Second thing as well, we do offer trade signals by Trading Central, and they offer 2 different trading platforms. The research platform, which gives you updates on indices, currency markets and commodities, and then they have future ideas, which predominantly is currency ideas. So if you are interested in having more support than just the courses, you want to take the courses and want that extra bit of piece of information with stop losses and take profits and all that, then we offer that as well for anyone that has an ATFX account. All right, if you have any questions, just put them here in the comment section. What we can do here is actually reply back directly into the comment section, and that way we can sort of address any questions you may have. So just leave a comment here. It might be just a simple thank you, or it can be a question as well. If you want to reach out to me directly as well, you can always do that via Twitter, via AlexFX00, and also via alejandro.zambrano@atfx.com. Thanks so much for watching, and I hope to see you guys very soon. Don't forget to subscribe. Bye-bye.